Our second of the three things is an understanding of the effect of rising interest rates. Now, we talked about inflation and needing your income to rise, but from an investment perspective is where we're going to dive in here, the effect of rising interest rates, because we have been talking for a long time about a rising interest rate environment. They have been near the bottom. They really can't go much lower, but for decades it has been a decreasing interest rate environment. We saw it uptick about 2 or 3 years ago, and the market had a fit over that, but we are seeing those inflationary pressures. These kind of all go hand in hand, right, John?
That's right.
The inflationary pressures are pushing yields higher, and that has an adverse effect on bond prices, which can have a negative impact on a traditional 60-40 portfolio.
Yeah, and I want to approach this, guys, by being, again, very balanced in our commentary about this, because the knee-jerk reaction for just about anybody when you say, okay, this asset class like bonds is really kind of out of favor. Oh, well, let's just get out of that. We don't want anything to do with that. Bonds play a role in your portfolio, even in a rising interest rate environment. So don't throw the baby out with the bathwater, so to speak. Don't knee-jerk react to this by saying, I just want totally out of bonds and all into equity. When you do that, you raise your risk profile tremendously. Bonds still play an important role in your portfolio. You will find bonds in the portfolios that we have here at GenWealth. But I think the key that you have to understand is that all bonds are not equal. All bonds don't perform the same way. But bond prices are affected by interest rates. So let's go back to school on this. As interest rates have been coming down, we've seen bond prices escalate over the last 20 or 25 years or so. It's been a really big time bonanza if you've been a long-term bond investor over the last 20 or 25 years. Well, now that trend is shifting, and now we're seeing rising interest rates, which means bond prices are going to decline. Now, that's a generalization, a very broad generalized statement about bond prices. But there are things, Candace, like adjustable rate bonds, mortgage-backed securities, things like that don't perform in the same way that a traditional 30-year treasury bond would perform as.
Yeah, and also real estate. Real estate's another component of our portfolios for income plans that we do for our clients, because real estate will give us, some yield that we need for a particular segment without subjecting it to interest rates rising and decreasing, and then also the volatility of the market.
Want more content like this delivered to your inbox weekly? Visit fastest4.com to learn more.